Good afternoon. This is Steve Nicholson at International Food Products in St. Louis, and we're talking today about macroeconomics and commodity markets. It's somewhat timely we do this today. This is the day that Chairman Bernanke is speaking to a group at Jackson Hole, Wyoming, and it's also the day the Commerce Department came out and revised the second quarter U.S. GDP down from 1.3 to 1%. Again, emphasizing how slow the economy is growing and how anemic the economy is in general. But we want to focus on the relationship between commodity markets and the macroeconomics. As many of you know, macroeconomics has been an influence on commodity markets here for about the last 2 or 3 years and has had a major influence. In the past, that hasn't been the case. Many of the markets now are all intertwined. Money moves between different markets. Whether it's equities, whether it's stocks, whether it's bonds, very, very quickly these days, where before that, was not as easy a process. The other point that we have to think about is that the economic growth of both here in the Western economies in particular, the United States and Europe, is very anemic, like we just said about the second quarter growth here in the United States. And because of that growth, the growth is not happening because of all sorts of issues. Political dysfunction, growing debt, both consumer and public debt, and so that's really hampering economies from growing. And that goes into the last third point and kind of hooks it all together, is that if you have the economies growing slowly, consumers are pulling in, their food demand has changed dramatically. Where food demand, mostly a lot of it was outside the home, and so that, consumers are not doing that. They're only going out once or twice a week, where they might have been going out 3 or 4 or 5 times a week. And so now their demand for food has changed, and so you don't have that big demand coming through the system, and so demand for food comes a little bit lower. So the market's perception is that if economic growth is slow, so will be the demand for food consumption, which then produces bearish or produces a downward move in commodity prices. Thank you for listening to this video, and this is Steve Nicholson from International Food Products in St. Louis, Missouri.